let's welcome everybody to, hello everybody, welcome. And then let's go ahead and I'll read your bio, Mark, and then you can read mine so we can introduce each other so people from your community get to know me and vice versa. Although I will say the people from my community have heard from you many times, so they all know who you are. Julia, hello. Okay, good. So everybody, welcome to the webinar. I'm so excited to talk about how we can build wealth while paying taxes. Like, who'd have thunk that was even possible? So I'm super excited about this conversation. And I want to introduce you, for those of you who don't know Mark Willis, who is going to be doing our presentation today. Let me go ahead and reintroduce him to you. So Mark Willis is a man on a mission to help you think differently about banks, Wall Street, and financial uncertainty. After graduating with 6 figures of student loan debt and discovering a way to turn his debt into real wealth, that's pretty cool. As he watched everyone else lose their retirement investment and home equity in 2008, he knew that he needed to find a sane way to meet his financial objectives and those of his clients. Mark is a certified financial planner, a #1 best-selling author, and owner of Lake Growth Financial Services, a financial firm in Chicago, Illinois. Over the years, he has helped hundreds of his clients take back control of their financial future and build their businesses with sophisticated, tax-efficient financial solutions. He specializes in building custom-tailored financial strategies that are unknown to typical financial gurus. As co-host of the Not Your Average Financial podcast, which I've been on, which was awesome, he shares some of his strategies for investing in real estate, saving and paying for college without going broke, and creating an income in retirement you can't outlive. Mark works with people who want to grow their wealth in ways that are safe and predictable to become their own source of financing and create tax-free income in retirement. And one of the big reasons, I just want to add a little note here, that one of the big reasons I was so excited to bring Mark back to do this full webinar was because several of the ladies that listen to my podcast, which is Real Estate Investing for Women, several ladies signed up with Mark to work with him to grow their own wealth, and they love the system. And so once I get feedback from my ladies that they love somebody that was on my show, of course I want to bring him back. So that's why I decided to partner with Mark for this webinar. So Mark, thank you. Welcome.
My pleasure, Moneeka. And for those unfamiliar, I hope everyone gets to know you, because you, as described, are one of the most blissful people, guys, you will ever meet in your life. That's certainly true in my book. Moneeka, you and I have known each other for a few years now, and due to COVID and some other things, haven't met face to face yet, but I just love virtually being around you, and I know I'll love being around you in person when that day comes again. But you have done some remarkable things over your life. And I'll read this off to folks so you guys can get a sense of who's on the call with us today. Moneeka has been investing in real estate for over 20 years and through all different market cycles. So that would include 2008 and 2000 and more. Still, Moneeka turned $10,000 into $2 million only just by working 5 to 10 hours a month. No, I didn't misread that. That's not a typo. 5 to 10 hours per month with very little stress. So while building a multi-million-dollar business, you've traveled, Moneeka, to over 55 countries, dances every day. You support causes that are important to you. You spend time with your husband of over 20 years. Congratulations on that. That's awesome. You're a #1 best-selling author. In fact, we had the privilege of co-authoring a book together last year, which was awesome. Your key #1 best-selling book, though, is Choose Bliss, The Power and Practice of Joy and Contentment. You're the host and podcast investing specialist for real estate investing for women. Expertise is bliss-filled. You've been featured on stages, radio, podcasts, TV stations. I don't know, billboards? Are you on any billboards yet?
I have.
Oh, are you really? Okay. Well, you're all over.
By accident. I know.
But, well, okay, 30 seconds to hear that story. Wow, how do you accidentally end up on a billboard?
I sent out a press release and I got a picture back from one of my listeners saying, Moneeka, I just saw this and I was on a billboard. They must have had an empty and wanted to put something up there. It was the strangest, coolest thing. But
wow.
I don't know
What
if
do you
it's
say?
still up.
One of the famous questions I hear other really well thoughtful, really well thought out interviews going is if you had your chance to have a billboard, what would you say on it? So Moneeka, what was on your billboard?
My
Do you remember?
billboard, it just said real estate investing for women. And so it was
Mm,
big. It was about it
good.
was about the podcast.
Oh,
And then a
cool.
little print. I don't know how many people got it, but live your bliss, retire rich.
Oh, cool. Live your
Yeah.
bliss, retire rich.
Yeah.
That's a good summary of what we're going to be covering. And anytime you get to be around Moneeka, guys, take that opportunity. There's a little phrase in the psychological counseling world called joy strength. And some people have very weak joy strength. If you just smile at them, they're going to frown. They're going to avert their eyes. But one of the best things I love about Moneeka is you help build my joy strength, Moneeka. And that's no lie. You help me and help all of us, I think, lift our spirits, look toward the future, build toward optimism, even in the midst of tragedy and loss and hardship that you and I and all of us experience. So thank you for your joy strength. All right.
My pleasure. I feel the same way about you, Mark, I have to say. So
Awesome.
thank you.
Well, what are we going to do today, Moneeka? How do you want to play in the sandbox together?
Well, so you've got an amazing presentation. So I want that to be shared with my ladies and with everybody that's on this webinar. And then afterwards, we will have some time for some Q&A. So Mark and I have both put aside about 90 minutes for this so that you guys can ask as many questions as possible. So let's just get started. Why don't you start with your presentation? I'm excited to see it.
I'm going to keep a little timer here. I want to see if we can get through the content as effectively and efficiently and as fast as we can so we can get to questions. And as the day ends, I want to make sure you guys have plenty of time to get to where you're going next. But this might just change the rest of your financial life. I don't say that often, and it's not going to be about me or anything I can do. It's really about you guys. And so let me share my screen. We'll get right into the content. One more thing before we get in, you will have, if you're listening at all, you will have questions as we go through this. So I do recommend, if possible, to focus on what we're going to be discussing for this short time. There's going to be email notifications and more, but I'm going to really encourage you guys. There may even be some prizes as we go through. But if we're able to get through and you have a question as we go through, no doubt there will be questions. I really do recommend don't wait till the end to write your question down. It will be tempting to want to just zip right by, but take that moment, put it in the Q&A box, and make sure even if we get to it later, we'll come back to it. You'll be glad that you wrote your question down rather than it moving right by us, okay? So I'm watching my clock here. I'm going to try to do about 40 minutes of content interspersed with polls and questions. So as we go through, the first thing I want to make sure to cover is, of course, I'm not an accountant, so I won't be giving any exact, you and me tax advice here. I'm not a tax professional. I am a certified financial planner, but I am not your CPA. So chat with your CPA about everything we'll be covering today. And that goes for Moneeka too. Unless you're a CPA and I didn't realize it, Moneeka, is that?
No,
right?
absolutely
Okay.
not. I have no skill in that area.
Neither do I want to. We can
right.
talk. I just never want to fill out a tax return. I don't even do it myself. I give it to my CPA, and of course I read it and look at it. But that's what they're there for, guys. So, okay, really quickly, who is this going to be for today? Make sure you're in the right place. This is anybody paying taxes. So that could be anybody really of any country. I just picked USA, Canada, United Kingdom, any business owner, sole prop, LLC, S Corp, C Corp, real estate investor, even if you get a refund at the end of each year, this is going to be for you guys. So you're in the right place if taxes are a part of your financial life. That's going to be most of us, I'd say.
Hopefully.
Yeah. If not,
the only time you don't pay taxes is if you're not making money, right? So you want to be
well said.
You want to be paying those taxes.
Well said. That's right. Yep. We've already gone on enough about me, so I'll pass by this. But one of my favorite accomplishments, besides the bottom line there, my family and faith and so forth, is Moneeka, you and I wrote a book together. How about that?
Yay!
You did a great job putting that together. Thank you. Do you want to share 30 seconds on what this book was all about?
So this book was based on my conversations that I had on my podcast, which is called Real Estate Investing for Women, the same title of the book. And what I found was that there were several of my guests that people kept asking questions about. And so what I wanted to do is make those guests available to more people. A lot of people use different formats. Like some people like to read, some people like to listen to a podcast, whatever. So I took my most popular shows, one of which was Mark, and asked them to be in this book so people can have it at their fingertips. And it was just such a delightful project to put together, and we've had amazing responses from people.
It's great. Yeah. Very cool. Well, it's been my privilege and I've shared your content, and guys, those that stay to the end will get a free chapter of that book. So stick around, don't bow out yet. And by the way, if you must leave early, write down the website bit.ly/wealth-with-taxes, bit.ly/wealth-with-taxes. And we'd be happy to chat further about these strategies. If you don't remember anything else, just go to bit.ly/wealth-with-taxes. The other thing I'll mention quickly is that we've just started a membership site, and if you can remember two URLs, it's notyouraverage.mn.co. That's notyouraverage.mn.co. It's our community site. We've got several hundred members on there already, just a month in. We're talking about some of these tax strategies, how to build real wealth, no matter what the markets are doing, no matter what tax rates do. We just had I think maybe some coming changes in the years to come regarding our taxes. So it's important to make plans. So a couple of fun things. We've got to have some internet memes on internet memes on taxes, right? So the IRS motto, we have what it takes to take what you have. My favorite one is, like the sign says, it's all theirs. The IRS, you spell those words together, you get the word theirs. So that's my favorite one. Now, guys, if you don't like paying taxes, you're not alone. Obviously, nobody likes paying taxes, at least not when they come to you due it as a surprise. Now, I live in Chicago area, and I get it. Potholes are real. And so I'm glad to pay the taxes due for the services that we all enjoy as a member of this wonderful country. But it's important to realize what's happening when you give money away to the government to provide the services that we all enjoy. That's a dollar you can't give to anybody else. Okay. And it's important also to realize that before 1913, there was no income tax. Think about that for a minute. Imagine keeping every dollar you earned in your business with nobody else to take a piece of it. Now, that's a big piece. I recently heard that California has some taxes coming into play on text messages. In fact, this might be already in place, taxes on your text messages. Now, there used to be a tax on minutes you spent talking on the phone to help subsidize people who couldn't afford cell phones. And that's a good thing, right? But now that we're all texting, we're not on the phone as much. So that revenue source is drying up. So the government's looking at other ways to raise cost of smartphones and raise revenue. So, I would suspect that we'll stop texting and we might start, Zooming. What do you know? There might be a Zoom tax before this is all said and done. The key piece
Put
is
that one out there, please.
Oh, no, I didn't say anything. Nobody heard me say that. So where's all the money going? It's going to operate and serve and generate the revenue we need to just meet our obligations. The Internal Revenue Service was born in 1913. Before that, the government even had surpluses, strangely enough. Now, many people believe that it's not possible to lower your taxes, that they just have to pay it and there's no getting around it. But I love saving taxes. I love helping my clients save taxes. And most importantly, I love seeing how saving taxes legally can be directly related to building real wealth. Now, there's actually plenty of congressional interviews and on-the-record statements saying that there's an absolute legal right for every American citizen to pay as little as possible, legally, of course, to the IRS, that you're not obligated, the law says, to pay a single dime more than you're absolutely required to pay on your taxes. So it's good to lower our taxes. It's also good to think about, what do we do with the money we still have to pay the IRS, and how do we make that purchase? How do we make that payment to the IRS? I kind of view my tax payment as part of my patriotic duty. It's also a purchase of another year of living in this great country, so that's a good thing. But I feel like too many times there's kind of an issue with our tax professionals. CPAs are oftentimes they're really great with numbers, but that also might mean they're not wonderful communicators. Okay, just personalities. That's just the way they oftentimes go. Not everybody, of course, but there are some powerful ways if your tax professional is not communicating with you some of the strategies that are available to you, you're missing out on hundreds of thousands and maybe even more in your wealth. Now, that's on our personal side. Let's take a moment and just look at the grand scale of things. So, from start to finish, this is the tax revenue as a percentage of GDP. And, it's funny and it's easy to kick around the IRS, but they're doing what's necessary to support a nation that's got a major spending problem. Without the IRS, we'd be even in worse shape. So, look at the IRS values before the early years of our country. That's 1792 for those who can't see that tiny number there. And before we had income tax, we had tariffs, excise taxes, and more. And then right around the start of World War I, we started paying small amounts of money into an income tax system. And then in World War II, you can see it jumped up dramatically to a large portion of our GDP was covered by taxes. And somewhere along the way, something called a payroll tax was added. And there's a whole story here, which I won't bore you to details with, but it's not always been the case that we had an income tax or a payroll tax. And it's important to realize that as we look at what our options are today. If you walk into a movie 45 minutes late, it's sometimes hard to remember what the story is or understand why the characters are acting this way or why she kissed him or he punched her or he or she punched him. The story doesn't make sense unless we have the entire context. So it's important to realize when you look at taxes what the story is. So bottom line is we started taxing our income as a result of several deficits and more spending. And since then, and this is kind of a fascinating chart, we went from, if you can see it here, this is the marginal tax rates on the top and the top estate tax rate from that time when we started getting taxes due on our income till today. Now, Moneeka, what do you notice about those blue points on that chart? It starts out really low, right? As we get started.
And then it just keeps climbing.
Camel nose under the tent, so to speak, and then boom, it climbs all the way up to 80%, comes down again temporarily after World War I, and then World War II brings our top marginal tax rate, can you believe this, guys, up to 91%. That was the top income tax rate. Can you imagine if you made $100 and the government took $91? How incentivized might you be to continue to work? And it stayed that way for a good long while. Kennedy had some tax cuts right there. We had several other tax cuts in the 80s through Reagan and Congress. And then we've had a few raises, of course, and we're back down slightly. This is the Tax Cuts and Jobs Act. If you can see it, it's so tiny, it's almost hard to read it there. But that was our last major tax revision, if you can call that major, at the end of the chart there. Okay. So now, even back in ancient England, a couple hundred years ago, serfs and feudal lords had a relationship where the serfs, the servants, would pay a whopping 25% of their income to feudal lords. Now, here we are in the land of the free, and we're paying, if you add state, local, and federal government together, depending on if you're in a wonderful state like California or my state, Illinois, your total obligation to the government might be close to 50%, depending on your tax bracket. 50%. And that's with our low rates. Now, Moneeka, please forgive me, but I'm going to ask you to be my guinea pig throughout here, I think.
Of course.
And tell you what, let me hush for a minute. Guys, as you look at the chart, put into the chat, as you look at the chart here, are we in a low tax rate environment or a high tax rate environment, historically speaking? As of today, this year, are taxes low historically? or are taxes high? I'm going to give folks a moment. John writes medium.
That's
low.
what I was going to say, John.
Yeah. Yeah.
Thanks,
Certainly not
Erica.
zero.
Yeah.
Yeah. Thanks. Yeah, you're right. Yeah, Erica, it does appear historically, for the last 40 years or so, we're in the lower realm and medium, I guess, overall, right? So what do we do? That is the current reality. Now, my question would be, maybe more relevant, is where are tax rates headed in the future? I don't know. Nobody knows, but we have some guesses. If we were to look at government debt as a percentage of GDP, that is dramatically going up. And, we had 2020 last year, of course, brought new territory into the word deficit spending. We didn't quite hit 4.2. I think we ended up with $3.8 trillion of annual deficit spending, which is almost impossible to fathom how big that is. And we see that continuing to project toward 4.2 trillion actually annually over the next 10 years. Okay, so part of that is the interest payment on the debt itself. So I promise we're getting to some good news, but I have to explain the reality of things first. So at some point in the next few years, we expect the debt interest payment will be the largest portion, larger than our military expense, and soon it'll even exceed Social Security and Medicare, just to service the payments we have on our debt. Not to cover kids' schools, not to cover elderly care, not to cover those wonderful potholes we have in Chicago, just to pay the guy or gal that loaned us some money last year. And that's going to be a uphill climb, an avalanche. It's like climbing up an avalanche. It's very difficult to get past that once you get to a certain sticking point. And it's not just the government, of course. It's all of us. The federal government, but state and local governments, households account for a large portion of the overall debt in this country. But if you totaled it all up, we're about 4.5 times our revenue is our debt. So if I made $100,000 this last year, but I spent $450,000, Moneeka, last year, am I on track to a financially stress-free future? If I made $100,000,
absolutely not. That sounds like a scary situation.
Yeah. So all of this is going toward the key piece, which is the CPO is still projecting $1 trillion deficits into the future. Where are they going to get that money? Are they going to increase taxes or lower government spending, or worse, are they going to borrow more money? And what impact will all that debt have on our financial future? Where is the government going to get the money to pay these taxes? Are they going to take that money from people who have nothing to give? Or most likely with many of the people on this call, you guys have money, we all have money. Is the government going to take from those of us who do have savings, reserves, assets, real estate, stocks, et cetera, 401ks, et cetera? And my next question rattled my bones when I thought through some of this myself. Should you increase or decrease your dependence on your government and government-sponsored retirement plans under these circumstances? I don't have an answer for that. I don't have a opinion for you. I don't know you guys like you, but where are they going to get that money to provide those services? So ask yourself, do you think taxes are going to be lower or higher in the future? And I'm already seeing some people saying here, up, taxes are going to go higher. So I'm not a political person. I had to be reminded yesterday was Inauguration Day. I'm ashamed to say that as we're recording this. But I was so pleased with the outcome and how civil everyone was. That made me just so glad. Feel like that was a breath of fresh air. But I just, I don't have a dog in the fight for the politics of the matter. I'm just wondering, on a mathematical basis, are taxes going to be higher in the future? And do you think they could be way higher in the future? And do you want to pay those taxes? These are important questions. Do you want to pay those taxes? Now, most people, sure. How do you say Chaitra?
Chai.
Chai, thank you.
Chai, yeah.
Chai, right on. All right, awesome.
Hi, Chai.
Yes, yeah. Hi, Chai. I love it. Absolutely right. Thank you. So your ticking tax time bomb. If you're looking at your 401k, your IRA, or any of the other kissing cousins below in the list there, then you have, unfortunately, a ticking tax time bomb in your portfolio. So what little we have all saved for retirement will be taxed in retirement. And most CPAs will recommend that list I just gave you there. Tax deferral is a misnomer, or at least it's a little vague. I get the word tax deferral. I know what the word deferral means, but when I hear tax deferral, that sounds good. I like to put things off, but if I use the word tax postponed, that has a slightly more somber feeling to it, right? So most 401ks, IRAs, and more are tax postponed. That means, like if you postpone your visit to the dentist, things get worse and worse and worse. Postponing a root canal is not a great idea. So would you rather pay your taxes on the seed or the harvest? Most retirement plans pay taxes on the harvest. Guys, there's no right or wrong here, but mathematically speaking, if taxes are going to go up in the future, then, or if you think you're going to be poorer in retirement, then taxes in the future, if they're going to go up, or if you think you're going to be successful in your retirement, which is what Moneeka helps us do with real estate, then at the end of the game, we'll end up paying bigger taxes on a bigger number if taxes go up and we're successful in our investments. So paying taxes on the seed gets the tax out of the way and lets us have a tax-free harvest. That's the key. So most economists are saying taxes are going up. Even in the next 8 years, most people project it could even double. Our tax rates could double by the end of the decade, 2029. And most tax postponed plans disallow us from some of the benefits that we'll be describing today. In fact, if you look at the lifespan of a typical 401k, your money is in a penalty zone and a tax zone for its entire life. Almost 85% of the life of your money is in a penalty zone. Either it's an early withdrawal penalty, or at 72 plus, you get a required minimum distribution penalty. If you don't take the money out, you're taxed 50% to hold your cash, 50% to hold that cash in the 401k when you should have took it out. Essentially, when you get to a certain age, the government's tired of waiting and they're ready to start taking taxes off that 401k. So there's a few things we're going to cover with our time we have left, about 20 minutes or so. I hope to do this. Step one, we're going to lower our taxes. Step two, the key piece to this whole presentation is how do we build wealth on our remaining tax burden? And then step three, pass your wealth on to future generations rather than the IRS. There's some really big gotchas in IRAs and 401ks. If you leave those to your heirs, the IRS becomes the biggest beneficiary of your hard-earned savings. So stay to the end for number three, but we'll go through each of these step by step. Step one, here's some just quick, easy ways you guys can lower your taxes, strategies to lower your taxes. Here's a few. One, make sure to keep receipts on everything you do. You can basically write off almost anything if you've got good records. Work with your accountant on each of these pieces. Step two, or another key piece, you can pay for your cars through your business with any other major expense included if you've got a Section 179 deduction. In fact, Moneeka, I don't know if you knew this, but if you buy a car heavy enough, you get a bigger deduction. So the car has to weigh. You did? Okay, cool.
Yeah.
I actually jokingly talked to my accountant and said, could I just throw some cement blocks in my trunk?
That's right. Put in a couple new batteries.
Yeah, exactly. Yes. Yeah. I love it. So if you've got a large enough vehicle, I think that's why a lot of executives drive larger SUVs for this reason. You get a larger deduction under the Section 179 deduction for cars. Guys, you can do bonus depreciation on big assets, whether it's real estate or even private airplanes and more. Under the Tax Cuts and Jobs Act, that deduction limit goes up to $1 million for 2018 and beyond. So you can even lift it higher with certain equipment purchases to a deduction of up to 2.5 million bucks from now going forward till the tax cuts expire in 2025. Now, this is under current law, of course. So even this year, there may be some changes to some of this. So talk to your accountant about some of this. Now, one of the other key pieces to this. And Moneeka, we couldn't meet in person when we had that summit last year, but I want to encourage you, not just because I love hanging out with you, but if you do another summit someday, to have it in your own home. Because if you do that, you can have a comparable sheet of the best hotels in your area and what that hotel would charge you to go have that meeting, that summit downtown at the Hilton or the Four Seasons or whatever. And then you've got a comparable sheet and you can charge your business to meet in your living room. And keep that comparables, use that as part of your deductible expenses going forward. And for your taxes, you can have it as a tax write-off without losing that money for the expense. You didn't give the money to the Hilton, but you still get to write that off as a comparable. By renting your home to your business, you can do exactly that. A couple other pieces. Make sure, guys, that you're doing all you can with 199A deductions. Talk to your accountant about what's possible there for you. You can employ your kids to give them tax-free money. If you've got or family members, that would include elderly adults, by the way, where you can pay them a certain amount and there's no taxes due up to certain thresholds of their income. And like I say, don't leave your IRA to more than one beneficiary. Talk to your estate planning attorney about what you can do there. But I will just mention that if you've got your money going to more than one beneficiary, you must really love somebody at the IRS, because the IRS is the one that will get the lion's share of your inheritance. So we'll do the math on that if we have time at the end. Remind me if I don't have time, we'll do it another way. We'll get it to you guys another way. Okay, so step 2, build wealth by paying your taxes. This is, I think, one of the most mind-blowing ways to not only reduce my tax, but now how do I turn the problem of that tax bill into a solution? If anyone is into judo or akimbo or aikido or any of the kind of the martial arts where you're using the force against you as your way to take over or change or leverage that force against you to your advantage, then this is a way you can take the problem of paying your taxes. And if you're a reasonably successful business person, it might mean hundreds of thousands or even millions of dollars over your lifetime just by paying your taxes this way. So what if you could find a way to grow money while satisfying the Internal Revenue Service? In fact, I would say your life's most important financial decision is how to pay for your life's biggest expense, your tax bill. And that's unfortunate, but that's true. Your biggest life's expense is your overall lifetime tax bill. We will send more to the IRS than we will spend on our husbands, our children, our vacations, our cars, our real estate. The IRS will get more as the single recipient of your hard-earned money over your lifetime than any other recipient. Let's just do the math on that quickly. If you just cut a check for your taxes every year, whether it's through payroll taxes or you actually do write a check to the IRS, what's it look like? Well, for an age 35-year-old person, maybe they're making maybe they're making 50 grand a year. That would mean at that tax bracket, they'd pay 6 grand a year in taxes. Let's say they never had a pay raise, and for 35 years, they paid that 6 grand a year. $6,000 times 35 years is $210,000 to the IRS. Now that's a lot of money just to keep the IRS happy. But what really was lost was what your $210,000 would have grown to had you left that money invested. If you didn't need to spend it at the IRS store, then you could see your 6 grand over 35 years earning 5% in some sort of investment could grow to over $500,000, $541,000 just by paying your taxes. That's a lot of money. And guys, we're paying a lot more than just 6 grand a year. We got our income tax, that's for sure. And that's what we see every paycheck and once a year in April. But we've got sales taxes, excise taxes, travel taxes, capital gains taxes, our estate tax, the payroll tax, business taxes, property taxes. It becomes overwhelming. And most of us have 2 ways we buy, or I say buy, but we pay for our taxes. There's really only 2 ways to pay for our taxes. One way is to save up for them all year long. And the other way is to wake up on April 1st and realize, oh man, I owe a ton of money. How am I going to pay this? And you get into some sort of payment plan with the IRS. Let's take that first one in turn. So if you get into a payment plan with the IRS, or maybe you take a business loan to pay your taxes, what's happening is you've gone below net zero, and now you're underneath the net zero line. And over the next year or longer, you're in that regular payment schedule with the IRS. You're having to crawl and scratch your way back to net zero. And then what happens? Well, the IRS wants more money next year. So what do? You take out another loan. And now we're back all over again. We're just climbing and scratching our way back up to net zero. And we're constantly on that treadmill of getting back up to net zero. Now, the savvier folks on the webinar here understand that by saving for your taxes, some people do profit first, other people just have it in a regular savings account, but you save for that tax bill. And then April 15th is right here, or March 15th, or whenever you pay your taxes, it's right here. So once I take my money out of my savings account, or your quarterly payments, I guess, would be right here. Every time I take money out of cash savings, I stop growing my money, and it never grows again. That money is gone forever. And then what? I have to start repaying my savings account to get ready for next quarter or next year's tax bill. Now, if you guys are looking at this chart, I notice that there's some eerie similarities between the debt staircase and the savers staircase. They both end up at zero. And most of us end up at zero. That's the problem. That's why 51% of Americans are going to be, according to the Boston Center of Retirement Research, just came out this year, study came out just this year, half of all Americans will have to reduce their standard of living in retirement. And by the way, it was about that. It was 49% before the pandemic. So we've been in a major retirement readiness crisis for many years. And this is a big reason why. It's not, can we reach for 8% instead of 7% on our mutual funds? It's because we keep paying cash for stuff or using a credit card for stuff and landing like, a sack of potatoes back at net zero. So what if there was a better way? What if there was a third way to pay your taxes and any other major purchase, by the way, that allowed you to spend the money, but still have it working for you? Wouldn't that be the default way to make your large purchases and your tax payments? If you could lift off from net zero like this and then continually access the money for major expenses like taxes, real estate, your cars, and more, wouldn't that be a great way to make major purchases? I mean, what else could you imagine there? You could buy your cars, vacations, home repairs, real estate investments, pay off your bills, your debts. What about paying for your kids' college, your business and real estate expenses? We had a person the other day, they just used this to invest in some real estate. If this is a tool that you could use, wouldn't you want to know about it? So you're able to get through this entire life cycle and come up with anything else you could imagine too. Now, a lot of people say, well, this is a nice idea, Mark, but bring it down the ladder for us. What could do that? There's only a few things that could grow even when you use it. And that's what that chart showed, where it grows even when you access the cash. One is 401k loans, and they will let you borrow the money and let it continue to grow somewhat, but they'll only give you 50 grand or 50,000 or 50%, whichever is less. And the other problem is that you're taxed twice on the money. If you think about that, if I borrow out 20 grand against my 401k, I'm going to repay that 401k loan with money from my paycheck, after tax money. So that's the first time I'm taxed on a 401k loan. And then the money comes to me again in my retirement 20 years later or whatever. That's the second time I'm taxed on the exact same dollar. It's the highest interest debt I can have is a 401k loan. So don't be lured into the belief that 401k loans are a good deal. They're only a good deal to the IRS, who gets paid twice on the same dollar. HELOCs are another great example of how you could borrow against something and it still grows. My home doesn't care if I have a HELOC on it or not. Zillow doesn't care if I have a HELOC on it or not. Bank loans, but there are risks, right, with HELOCs and bank loans. So there's one more thing, and that is of all things in the financial universe, high cash value, dividend paying whole life insurance, AKA bank on yourself. Now, this is a tool that surprised me when I heard about it first. In fact, I almost stopped caring about it. I almost turned away from it because I was, I just had my own bias, I suppose. But I was, I guess encouraged to continue looking into it, and so glad I did. It became more compelling the more I learned about it. So what does it do? It grows contractually guaranteed every single year. Dividends are paid on top of that guarantee, like icing on the cake, from companies that are profitable. And most of the companies I work with have been paying a dividend for over 100 years. You can access the money via a loan inside your policy. The cash is available to you to spend for any reason. They can't refuse the money. It's your cash. There's no background check. There's no required repayment schedule. And maybe most surprisingly, and directly for our purposes with taxes today, you can borrow against these policies and it will continue to grow as if you did not touch a dime of the money. I'll say that again. If I've got $100,000 in my cash value, and let's say I borrowed out $30,000 to go buy a car, that year I'd get the same growth and dividends as if I hadn't taken the money on the entire $100,000, and I've got my car. That's remarkable. So we'll call that, for short, we'll call that a bank on yourself type whole life policy. Now, I'm going to just zip through this slide because we've got some other stuff to cover, but we can have a cost basis that's after tax. So it's tax-free when we access the money inside life insurance. The gains are tax-free. That's awesome. So it's like a Roth IRA, but without any of the restrictions of a Roth IRA, which means you can have a tax-free distribution in your retirement. Dividends, by the way, are classified as return of premium, so those are tax-free. Income tax-free death benefits, so the IRS is not going to be your beneficiary here. And then there's no adjustment on your gross income, so you could even keep more of your Social Security and Medicare and all that. You look super poor on paper, but you could be enjoying 6 or 7 figures a year of tax-free income. We have clients that are in your retirement years because life insurance does not get reported on your tax return. So it's all off the radar. And finally, there are no early withdrawal penalties and no required minimum distributions. So that's awesome. The tool itself has some tax advantages, but what about using the tool of life insurance to pay your tax bill? Now, again, this won't lower your taxes, but it will help you pay those taxes. Let's talk about it. Again, it has to be designed correctly from the beginning. It does not reduce your tax liability. So work with your accountant to get that tax bill down from a 50 grand tax bill to a 20 grand tax bill through deductions I mentioned in step 1. But once we're down to the bare bones of what you still have to pay the IRS, it's a great way for your business or your family to hold a space and make those tax payments. So here's how it works. Your money, including your tax payments, needs a place to live. So I'll say that again. Your money, all of your money, whether it's to buy a real estate deal or send your kid to college or pay for your taxes or anything else, needs a place to live. So we need the space of life insurance as a warehouse for our wealth. It's accessible. We can access the money in the policy. We have control over how we get the money in and out of the policy. And there's uninterrupted compounding growth on the policy. So that's a pretty cool place as a warehouse for our wealth. Now, we can pay our taxes with policy dollars in a 3-step process. First, put the money into the policy as you planned to save and prepare for your taxes. Second, borrow the money out of the policy and pay your taxes as you normally would. The IRS does not care how you pay them as long as they get paid. Of course, this is a legal instrument, so they do care about that, but they don't mind if it's coming from your checking account or your brokerage account or a whole life policy, as long as they're getting paid. And finally, pay off your loans with business profits. So, for example, maybe you have a windfall. Maybe you have an inheritance. Maybe you sell one of your real estate deals one day in the future. That's a spot for that profit to go. Let me show you what I mean. Now, here's an example. And I wanted these numbers to be realistic, but I really also want to stress that there are a lot of real world considerations here. And I got to stress that every person on this call will have different numbers in your mind. So please, this gentleman is Tommy taxpayer. He's going to pay $90,000 a year for his tax problem. Maybe your tax bill is 900,000, or maybe we knock off a zero and maybe you have a 9,000 tax problem. Okay, so the numbers are just proportional, but we're going to focus on this person's situation directly. So in his case, he felt like he needed to save $50,000 a year. He felt he could comfortably save 50 grand a year for his retirement. And he had this $90,000 bill, tax bill. So 50 plus 90 is $140,000. That's where we came up with this number right here. 140,000 is the amount of money going into the policy. They call that premium. Now, for a lot of people listening, that might be a jaw-dropping moment to think, why would I put six figures into a life insurance contract? That seems anathema. Hold that thought, because in the first year, he already has $94,000 of liquid cash that he could use, which is precisely what he needs to pay his tax bill that same year. And he has a death benefit there of 3.3 million bucks. Not too shabby. Now, what I want to kind of mention here is that starting in the second year, he has a loan for $90,000. That's him taking a tax bill payment out of his policy as a loan for $90,000 every single year for 20 years. And if you notice there, he never pays the loan off. Look at that. There's nobody calling him at dinner time, nobody repoing his car or his house. This is his cash. He can decide if he's going to pay this off or not. And even if he never paid the loan off, he has $1.2 million of cash value to spend in his retirement. And of course, a almost $6 million gift to his family. Now that's a great way to pay my tax bill, if you ask me. Okay, so what about those massive loans? Some people might be asking. Well, again, guys, the cash value grows with dividends and guarantees, but there is some loan interest. So I would recommend we find regular ways to pay those loans off. One way is to do it with business windfalls. So let's take a look. Most business owners I meet and work with over Zoom have windfalls. They have a blowout year. They're seeing their money growing and they have those great years. Maybe it's a real estate sale. Maybe it's a buyout of a partner. But whatever it is, I'm going to show every 5 years. Okay, so I do want to step aside here. You don't have to pay $140,000 a year, Elsania. You could pay less than that. You could pay more than that. The more you put in, the more cash you have. So again, your numbers are your numbers. Moneeka, would you want to add anything to that briefly? No?
Nope, I'm good.
Okay.
Thanks.
Yeah. In this example, this person is paying $140,000. And I will also mention he or she does not have to pay $140,000. That's their limit. That's their ceiling, but their floor is dramatically less. You could put in 50 grand, 20 grand, $0. In fact, I'll show that in a coming slide. He'll stop paying anything into this policy and he'll start withdrawing money out as a retirement income stream. Okay, I want to keep moving. We are getting close to the end, guys. So thank you for going through this with me. And for those not engineers, we're going to be past the spreadsheets here soon, but I love to show this because it's the real deal, right? This is a real life case. So this person, same guy, same numbers. He's loading up his policy loan here. And by year 5, he has a loan balance, pretty massive loan balance. And in year 6, he has a larger loan balance, but at the end of year 6, he pays off the loan with a windfall, $497,000. He has to put that money somewhere. It's either going to go into a taxable savings account, yuck, earning no interest, or it's going to go into this parking space, which is designed to be accessible at any time and have no taxes due on the money. So that's a pretty cool way to park your profits. So he throws $497,000 into the policy loan repayment, and he repeats this process every 5 years, taking a loan, paying off the loan, taking a loan, paying off the loan. And let's go down to the next slide here. Okay, so now he's down at age 65. Instead of $1.2 million, which is what he had he never paid off the loan, instead, guys, he has a $4.1 million money bucket that he could draw on, which under my calculations would allow this person to enjoy a retirement income of $266,000 a year from his age 66 to 100 without running out of cash. That's over $250,000 a year of tax-free income to last as long as he lives. Show me anything else that can do that. I love it. So this is if he pays off the loans. And this is what we'd recommend. You're welcome to pay off the loans as you please. Your numbers are your numbers. You can pay off the loans with occasional windfalls, which recycle the money. When you pay off with a windfall, maybe you just pay it all off when you sell your business someday. It's just all at once, golden parachute, boom. They give you $4 million, they give you all your money right there at the end, and you could wipe out the loan right there at the end. And you could even never pay off the loan. Back to our first example, he goes his entire life, he passes away, he'd still leave $5.8 million to his family. So it gives you some options. Now, what's the catch? Maybe that's something I should have put earlier in this presentation. Who will this not work for? It will not work for those that cannot save in the first place. If you're behind on your tax bill, if you have massive amounts of high interest credit card debt, just figure out a way to work it out with your creditors, and then let's talk about this strategy for your future. However, it's also not for people who are looking to get rich overnight. This is a long-term, safe and predictable and productive wealth building strategy. It's also not going to wow you with double-digit returns. Now, there's whole other strategies where we use the policy to invest in real estate and to get cash flowing assets working in your favor. The policy grows, the real estate appreciates, and this is where Moneeka really shines. Your strategies that you offer really shine, Moneeka. But when you couple the two together, it's like, I watched that movie Bonnie and Clyde. That's a bad example. It's like Thelma and Louise, It's like Batman and Robin. It's like Moneeka and Mark. It's just a great combination. So I think it's just a great way to combine the two together. So I would say if you're unwilling to imagine that there might be a better way of doing things, this won't work for you either. But we have such growth-minded people and such positive people in your audience, Moneeka, that I think it's a great strategy for those that are willing to think a little different about their money. Now, I will say, don't do this with a just Googled it advisor. I call them beginfluencers on Facebook or YouTube. They can really steer you astray. I was reading the other day that there are 400,000 life insurance agents in the United States. That's one for every 800 Americans. Guys, I'm not just an insurance agent, although I am. I'm also a certified financial planner, but more importantly, I'm a bank on yourself professional. So you really want to work with someone who's gone through that training credential. I kind of liken it to the difference between, if you go to the grocery store, you can sometimes see the USDA organic label on certain food. And then next to that food, there's a version that says natural. Okay. Natural has no credentials or whatever. It has no definition, really. My motor oil could be natural, but what I'm looking for is USDA organic, right? If I want those particular credentials met, if I want those standards of quality. And that's really what you need with this type of strategy. I've met too many people thought they had one of these, but it turned out their whole life policy was actually a variable policy tied to the stock market, which is what they didn't know. So I see our time. I'm going to pause for a minute, Moneeka. I only want to go here if we still have time and energy to do so. Why don't we just pull the car over? I just said a lot. Let me stop my screen share here. What questions have you had pop up in the chat, and what would you guys like to discuss?
So far, I have not heard anything that's popped up into the chat. So if anybody has any questions, please, this is exactly the time to ask it. We did have someone asked, is this the same presentation we actually did in the summit? And I think, Mark, if I remember correctly, we had more of a real estate focus. And so I think what's really relevant here is to understand that this strategy can work for any large purchase. So
Right.
in this case, we're talking about a $90,000 tax bill, right?
Yeah.
In our example, which is a large purchase, but
Hmm.
that you do every year, right? But what if you
Yep.
wanted to buy $100,000 home every
Yep.
year, right?
Yep.
Because you wanted to implement one of the cash flow strategies we've talked about on
Hmm.
my show, right?
Hmm.
So, or if you want to invest in your own business or whatever, right? You can do it's a strategy for any large purchase. So
Yep.
Erica, I know you were talking about, have we already discussed this before? Yes, with relationship to real estate, this is
Right.
specifically kind of focused on, oh yeah, you can do this in taxes too.
That's right. And in fact, I think we also talked about something called the debt snowbank method at the
Mm-hmm.
summit, which was a way to
Mm-hmm.
pay off your debt using the same tool. It's the same tool, but like a Swiss Army knife, it can really be applied to a lot of different scenarios. It's not a get it's not a be all end all. You still want, and I still have real estate in my portfolio, lots of it. I still have lots of other types of assets that give us other things to do. You don't want to try to drive your Swiss Army knife down the highway. That's not what it's there for, right? But the Swiss Army knife is pretty good at a lot of different things. Opening
Mm-hmm.
that can, fixing that door hinge, whatever. It's really good for a couple of really good things. I feel like it's probably underrepresented in most people's portfolios: liquidity, tax-free access, and so forth. But yeah, you can use it for various purposes: sending your kid to college, real estate purchases, like Moneeka talks about, and more.
Yeah, and another thing that I know Mark and I have had personal discussions about is that you can change the variables. So let's say, for instance, you don't have 20 years to retirement, you've only got 10. They can change for how much you put in each year, but they can also change the cash value death benefit that you
That's
get
right.
at the end. So you can make adjustments based on what you're needing in your life and what your goals are. Like how quickly do you need to be able to draw on that money?
Hmm.
And how much of a cash value do you want to leave? I know we were going to talk about legacy and stuff like that, but how much do you want to leave? For me, I have no children. I have one nephew, so I don't need a big cash value at death, right? So
Hmm.
there are different things that you can kind of adjust to make it
Absolutely.
more applicable to your life.
So true. And Moneeka, old fashioned whole life insurance was focused on death benefit, biggest is better, that sort of thing. What we just described, I know that was a giant death benefit on that person's screen, but that's actually the smallest amount of insurance you can purchase for the most amount of money going in. So we
Mm.
flip the script a little bit where we say, how little death benefit can we get away with for the biggest cash value available? Cuts my commissions by about 70%, by the way. And it floods the policy with liquidity because there's no fees. It's very little in fees, I should say. In fact, I'll quickly just show this little example, if you guys don't mind, for fun. Here's an example of someone who doesn't have 20 years to go. In fact, she doesn't even have 2 years. She funds it for exactly 1 year, and that's it. She's 61 when she starts her policy, so still a spring chicken, in the eyes of insurance companies.
Mhm.
And beautiful as always. This was a wonderful lady, a real client. Changed her name, of course, but 211,000 went into her policy. And look at how much cash value she had within 30 days of starting the policy. She's got $196,000 of cash value. And look at the gift she gets to leave to her favorite charity, or her, spouse, or, this person wanted to leave some of the money to a children's hospital that she volunteered with, by the way. So the 196,000 was really the focus. The death benefit was sort of a icing on the cake. The goal was, how can we get more money into the cash value side so we can borrow against it and get our money doing two things at once. She ended up using it to buy some real estate, and the renter is paying the loan off to this policy. But one of the key, and maybe one of my favorite ways to design these policies, is quick turnarounds like this, that for folks that need quick liquidity for real estate.
I do have one question from Candace. Candace is asked, first she says, great presentation. And she says, I'm refinancing my personal home, getting cash out, have whole life policy with loans taken out. Should I pay off those loans or put cash out in a whole new policy?
Oh, wow. That's
Oh,
a
that's
very
interesting.
nuanced, yeah, very nuanced question.
Yeah.
Um, Well, great questions. Well, I'll try to give as good an answer as I possibly can, but it will come down, Candace, to your details, what your overall goal is. But the interesting piece about, I don't know your loan, I don't know how long the policy's been in place, but let's assume that you really just, it could be 6 one, half dozen the other. You're not in danger of anything. You don't need the cash next Tuesday, for example. In the event where you've got the room, I would favor paying premiums over paying down the loan, but still having a strategy to pay down the loan to be paid off by the end of your, before you retire. That would be kind of the best of both worlds. Why is that? Well, we really do want to manage the policy loan. There's no requirement to pay it off, but it's always good to pay that down so you can have that money liquid again. But Candace, you asked a good question. The other way to get money into the policy is premium. And premium is where you're getting dividends. Loan repayments, there's no compound growth on a loan repayment. It's just paying off a loan. But when you put money into the policy as premium, it grows compounded for the rest of your life. If you're 60 or 40 or 20, that's just a longer period of time for that money to continue to compound and grow. 2 doors to every bank. There's the front door and the back door. The front door is where customers are coming in, paying off their policy loans. Back door is where the owners are coming in, packing money into the vault. What's the vault for? It's to loan it out to the guys and gals walking in the front. Now you are your own source of financing here. So you're the owner of the bank, and then you walk and come in through the front door and you borrow that cash out. It's a mind-bending concept, but that's the question you asked, Candace. Great question.
So I got a couple more questions here. First of all, what is the interest on the loans that you take?
Yeah. Wow. Yeah. Great question. That's not free to borrow from these policies. There is an interest rate. Let me give you a very simple couple of numbers. And guys, you might write 2 or 3 numbers down here. But let's just say you borrowed $10,000 to pay your taxes or to whatever, buy a car or down payment on a new property. $10,000. Keep that number in mind. And let's say that you decided of your own will to repay that loan over 4 years. Your total interest would be little about $700, $720 or so to pay off the loan. So that works out, if you do the math, to about 1.9% APR. 1.9%. Are there mortgages out there that are better than 1.9? I don't know. Probably not. Not that I'm aware of. So that's pretty cheap money. Now at the same time, that 10 grand was growing as if there was no loan. So even though I paid $700 some odd to borrow that money, that doesn't feel good to pay a interest on money. The policy itself was growing compounded on all 10 grand. Over 4 years with modest interest rates on the policy, that's about $2,000 of growth on 10,000. So you had 10 grand in there. It grew to 12 grand on its own, just keeping these numbers as simple as I can. So guys, what's the end of the day? What happened? We earned $2,000 and we only paid $700 for the privilege. So Moneeka, if you gave me $700 and the same day I gave you 2 grand back, how many times would you do that?
Every single day.
Yeah.
That's great. Yeah.
So, it's not free, but that's a short answer to the key is we have arbitrage. We have that growth.
That's right.
Between the growth of the policy and the loan interest.
Great. And then Chai is asking, how can we get more information about specifically how to use this money for buying real estate?
Wow. Yeah. Well, Moneeka, you're an expert on what to buy and where to buy it and how to make the purchases and to do it in a really systematic and blissful way where I'm really just here to help folks make the purchase. How you buy the deal is as important as what deal you buy. Go ahead.
So what I was just going to say is that, Chai, there are a lot of different strategies, right? So you might want to be. You guys know that there are strategies where you put in $20,000, there's $100,000, there's $1 million, right? So we decide on a strategy, and then you call Mark and have him do a breakdown of what this might look like for you. So, if you need to pull out a certain amount of money every single year, like you just did a breakdown, how he might help you to structure how much money you can pull, how much money you have to put in, when to pay off those loans, and how, as you're getting cash flow from properties, you might want to distribute that cash flow. Some of it you use for your own, your own lifestyle. Some of it you want to use for savings. But now when you're using that for savings, how do you want to distribute that? And I love what Mark had to say about, sometimes you put a little money through the front door and a little money through the back door, right? You pay off a little bit of your loan, so you're lowering your debt, but you put in more on premium, so you're making more over time. I really like that concept too, because then you don't have all your eggs in one basket. You still have significant growth happening.
Yeah.
So I know a lot of people are really all about paying off debt. I'm not like that. I like to use leverage debt as a tool for everything that we're doing. So really it's starting with the strategy and how much you need, and then talking to Mark about how to make that happen. That's what I would say would probably be the best strategy for figuring out how to use this for real estate. Do you have anything to add to that?
No, I agree. We sit down one-on-one in an advisory role with every person to really learn what your needs are. I don't presume that this tool will fit for you. We are a full financial firm. So, really that's why and I'll give the link one more time for folks, but it's bit.ly/wealth with taxes. We just sit down, chat over Zoom, just like this, or over a phone call if you prefer. And I listen. I've been yakking a lot today. I've been talking most of the time. I try to do more listening than talking, especially as we're getting to know each other, because no sense in us setting up something like this if it's not going to help you. It doesn't do you any good, doesn't do my business any good. The key is what do you want your money to do for you? And we go from there. That's where we start.
Love that. Does anybody else have any other questions? You're welcome, Chai. Good question.
Thank you,
by
Chai.
the way.
Thank you, Chai.
Yeah.
Moneeka, I'd be curious on your side of the ledger, like if folks have a strategy that fits with some of the philosophy you bring, just spark some imagination for me. How would this same tool apply in purchasing and using and building wealth through real estate?
Yeah. So, you're the expert on this tool. So, and I'm definitely so interested in it. So I want more conversations on that. But there's a couple of different thoughts that I have in my own head, and I'd love your feedback on this. But let's say, for instance, we want to buy a $100,000 home. Now, as a real estate investor, I like the leverage in buying real estate, right? So I only want to put 20% of my own money into this $100,000 home, right? So I'm not going to put $100,000 into anything. I'm putting $20,000. So the thought that I had was I would take $20,000. That's what I would actually put into your policy, right? And then next year I put that $20,000 into a home, and then I finance in traditional financing the other 80%. So I've really only put $20,000 in still. I still have a loan on that property, but that money, the $20,000, continues to earn not only the appreciation and the cash flow from the property, but it also gains interest compounded and dividends through the policy, through your policy, right?
That's great. That's fantastic, Moneeka. I love it. I agree with you. The higher your, the less skin in the game you have, the better ROI you have on the property. The more, but you know what? Having enough in the policy for additional deals. Maybe you bought 5 deals at 20 grand with your 100 grand, the key is you got to decide, and the bank is now working for your convenience rather than you working for the bank's convenience. Because you have the liquidity, you're more borrowable, you're more attractive to banks when you have a strong asset on your balance sheet, like whole life insurance, because that's a current asset. That's a current, very strong asset. And oftentimes a client will call me and say, Mark, I need a copy of the statement so I can show it to our bank. We're about to go to closing, and we just need to show that we've got 500 grand or 200 grand. We're not even using the policy for this purchase, Mark. We just want to show that we can buy this large property, multifamily or whatever. So I love it. Moneeka, very cool.
Cool.
Awesome. Well,
would you say anything to correct that? Or to even make it smarter?
Oh, no, I think that's great. In fact, what if we do this? Let's go all the way to the end. Let's say at the end, you've bought a bunch of properties. Okay. And maybe as you've been paying your mortgage, that mortgage has come down. Now you might do equity harvesting or whatever, but let's say that you've got most of your depreciation out of the way. So you took advantage of all the wonderful tax deductions I just shared with everybody at the beginning of this webinar. So all of your taxable deductions have gone away. Your mortgage interest is gone. All of your other tax deductions are gone, depreciation, cost segregation, if you do that. And now we're left with all this taxable rent coming at you like a flood. And hopefully, Moneeka, you've been a strong landlord and you've raised your rent to keep up with inflation at least. Okay. So that rent has taken your income sky high. Now, what did we just spend 20 minutes talking about? Taxes going down or tax going up? Taxes are very likely going to be really high when your income is really high. So we're in a big bad way right there, because now we're in all this taxable money is coming at us. What can we do? Well, if we've started a policy with massive amounts of cash in that policy at the time of retirement, even if we just started it last year, if we funded it the way we just showed Mary funding hers with one payment, then you can gift, if you don't want any taxes in your retirement, you could gift some or all of your rent to charity and then receive a tax-free money out of the whole life policy. And that provides a tax-free money to you, and all of the rent that you would have been paying taxes on goes to something you're now getting a deduction for, your charities. Somehow, some way, we've got to unwind that deferral. 1031 exchanges are just deferring the tax. The taxes due on that rent will come once all the depreciation and deductions are gone. So that's just a way you can actually get all of your rent tax-free when you're working right now, while there's still depreciation and deductions to be had, and tax-free in retirement once all of your tax advantages of real estate have gone away if you still hold the properties. So I'm always thinking, what's our exit ramp? How do we get, if we're going on, how do we get off? And how do we make sure that we don't pay more on the back end to the IRS than we were saving on the front end? That may have been clear as mud, but did that make sense?
It did. I think, this is another one of those things where you kind of want to write it down too, so you can see it visually. But it was really, really good. Thank you for that.
Sure.
So,
yeah.
And we do have someone who's really interested in seeing the last part of the presentation. So,
sure.
If we don't have any more questions, guys, let's go through the rest of the presentation, and then you can pop some more questions in here. We got about 15 more minutes, just so you know.
I'll see if we can get us out of here a little early. How about that?
Okay, great.
So bottom line is we're about $15.3 trillion in unmet coverage for families across the country in terms of life insurance or just estate gifts. I met a guy earlier today. His dad died when he was 8. He's now a professor. He was a professor of mine when I got my CFP, but his dad died when he was 8, leaving his mom and his siblings really in a hard spot. So, there are some major problems with folks, even if they have more money, they got more problems, right? There's estate tax issues. We're seeing a lot of talk around the estate tax guidelines coming down. They're very high right now. The estate tax limitations are sky high at 11 million per person. Many people see that coming back down to more historical rates. And so even if you have a couple of real estate deals, you might have some major estate tax problems. Plus there's complex probate. When you pass away, all that stuff is public record if you don't do it right. And then of course, liquid assets are going to have to be sold on the fire sale when you pass away. I jokingly say nobody at the funeral says, man, I hope he had or she had enough mutual funds. Just doesn't fit, right? So, most of the assets that we have in our life is taxable. Our checking accounts, brokerage accounts, taxable on death. But life insurance is income tax-free when we pass away. Again, we were just talking, Moneeka, about the exit ramp of our financial life. Whether it's leaving your business, selling your real estate deal, or passing away, ultimately, we need to think exit ramp. What's it going to do when we unwind this thing? Uh, Obviously, a lot of things are going to go through probate, but life insurance avoids probate, meaning it's private, meaning you pass it to your husband or your spouse or your charity or kids or whoever, you pass it to them directly outside of probate. It's there's a lot of times there's illiquidity of assets. Grandma's house or whatever has to get sold if you're going to divvy it up among the surviving kiddos. But life insurance is instantly liquid, and it helps with the mortgage, taxes, etc. In fact, life insurance is the only thing I'm aware of that instantly becomes more valuable when you die, except if you're a famous artist. That's the only other thing, which I am not, by the way. But my wife might be, but I am not. So it's just a way to leave your family more than you could ever save for them. It is completely liquid. So my mom passed away. God rest her soul. She passed away 4 years ago, almost this week. So when she passed away, she was awesome. And I love my mom, still do so much. I want her back a million times more than anything I'm about to say. But she did pass away. And when she did, my brother and I looked at the numbers of what she left us in life insurance. It was 1,000 times more than she had paid in premiums, 1,000 times more than she had paid in. That was a gift that changed my family tree. It's part of why I love what I do, of course. And I remember in the hospital, she was telling people to work with me. She was like giving me referrals at the. So I just love her so much. But the key is it solves so many problems upon passing. And so if you're leaving your IRA or 401k to your kids, keep in mind that the IRS would be your biggest beneficiary. So let's do the math on that very quickly. If you have an IRA of $500,000 and you've got two beneficiaries, now that could be a charity and your spouse, it could be two children, it could be your parents, it could be anything. But if you've got two kids, let's say, that means your 500 grand will go to two kids, 250, 250. Now each kid will have to pay his or her taxes on that $250,000. So that means they'll pay today's tax rates plus state tax. Let's say it's 40%. That means each kid gets 150 grand, but the IRS got the remainder. 1 + 1 is 2. The IRS got $200,000 and each kid got 150 grand. So who was the biggest beneficiary of your hard-earned money? The IRS. And that works every single time. Make sure that you don't have two beneficiaries on your qualified plans, IRAs, 401ks, and more. So many people do. It's unfortunate. I jokingly say you must love somebody big time at the IRS because you are leaving them the lion's share of your retirement. So what you guys can do, obviously, is get a coach. Commit to your success is number one. You are your greatest investment. No amount of tax strategy numbers we can throw at you will matter if you aren't committed to becoming a better version of yourself today than you were yesterday. Coaches are there to help, but only you can climb that mountain. So designing your solutions are a team effort, and I hope to serve you guys in any way possible. You can find out too why age or health issues does not rule you out for this strategy. So again, guys, you made it to the end. Congratulations.
Yay!
It's been a big webinar. So thank you, Moneeka. Everyone, if you fill out the form, just let me know that you came from today's webinar, and I'll make sure you guys get a free chapter of the book I had with Moneeka, and happy to have a 15-minute consult with you, no cost, just to hear what your thoughts were on this and answer any further questions after you've had a chance to sleep on it. So yeah, I think that's everything I got today. I left it all on the altar. Moneeka, any other thoughts, questions here today?
Nope, that was great. Lots of information. And, the part of the reason that I've had Mark on a couple times on the show and I wanted to do this webinar is it does feel like a lot of stuff. And so if you're even just thinking about it, give Mark a call. And he's got a whole team. I know Candace, I believe, is working with Oh, what is Amanda
Oh,
Healy
Amanda.
or
Oh,
whatever.
great,
Yeah. So we've
great.
had some
Yeah,
other
great.
people on the that have come on the show also from Mark's team. So so there are lots of different
Absolutely.
people, that have, and they work in different areas and stuff like that. So
Hmm.
he's got a lot of resources and can really help you to find the right solution for you, even if this isn't it.
That's right.
This may not be the exact right solution, but there are lots of different solutions. This is just kind of a big picture umbrella of what's possible. Right?
That's right. Yeah, we try to. You can't be a generalist. You got to be a specialist. We all have things that we love in the real estate space and more. This is one thing I love doing, but I don't think it's a good fit. So we do have other tools, strategies, and tactics to help you meet your goals without taking a bunch of unnecessary risks. And Moneeka, I just got to say, I know you have a choice with who you hang out with, and so I'm so glad we got to hang out over the last few years. I look forward to more ways we can play together in the sandbox, as I say.
Mhm.
It's just great being with you, and it's just a privilege to be with your community. And I hope we have even more fun in the future.
Yeah, I agree. And I feel the same way. I know there were a lot of names that joined today that did not come from my community, that came from yours. So it's been so nice to meet them and spend some time. So spend some time with you and with them. So I'm looking forward to opportunities for us to
Well,
share knowledge and help everybody to get really, really wealthy in the blissful way.
we started talking about you at the beginning. I really want to end with you too, Moneeka. Can you tell us what makes you and your community so successful, and how can folks find you where you are?
Oh, yeah. Thanks for asking that. So to find me, go to blissfulinvestor.com. And what makes us so different is that I lead with bliss. So there's so many people out there talking about real estate and businesses that are really all about the hustle, work hard, push hard. And it's my belief that you can have bliss while you improve your life, improve your joy, and grow a multi-million dollar business. I personally only spend 5 to 10 hours a month working on my business. And it has been my side hustle. I'll admit I had a corporate job for a while, but I haven't for the last 20 years. So this business has allowed that, and I really focus much more on the opposite of the hustle, which is to be blissful. So that's kind of what makes us a little different.
Awesome. And Julia put blissfulinvestor.com. Is that still the right one, best one to go to for folks that
Exactly.
want to
And
learn more?
you'll find everything about me there, including the podcast, our books, the book that Mark and I did together. That's on there too. So everything is there.
Awesome. Very cool. Well, Moneeka, thank you for this opportunity, and everybody keep listening. Take this moment before you end, go to Moneeka's iTunes page or Spotify or wherever you listen, give her a 5-star review, write her a full awesome review. Folks have to do their own promotion. I'm going to promote you, Moneeka. Everybody go put your name on her iTunes. I want to see everybody on there. They're gonna because it matters, right, Moneeka? People,
It
you
does.
need the feedback, and of course other people find you through reviews. So everybody enjoy leaving her a 5-star review. I can't wait to see everybody's comments and words. So
And same
thank you
with
again,
you.
Moneeka.
So mine is real estate investing for women, and yours is
Oh, not your average financial podcast. Yeah, we keep it short.
yeah. Exactly. So definitely reviews on both of those are really, really helpful. It gets the word out there.
Thank you. Well,
So
thank you again, Moneeka, and hope you have an awesome rest of your week. Thank you, guys. Make taxes fun. You can't say refund without fun in the word. So go have some fun with this and see what we come up with.
sounds great. Thank you everybody for joining us, and we will see you soon. Have a blissful day.